Welcome students. So after having talked about the financial estimates and projections conceptually or discussing it theoretically and knowing about the basic aspects of these important components of the overall project management or maybe the project identification, selection and financing. So now we will learn practically how to prepare the projected financial statements. As I told you, or maybe I discussed with you in the last class that after having the complete conceptual discussion on the financial estimates and projections, we will learn to prepare the projected financial statements also, so that we have a broad idea about that how the projected financial statements are prepared and what purpose they serve and how they are presented to the investors, maybe the venture capitalist or maybe the institutional investors or maybe any other kind of investors. So we will learn with the very simple examples the preparation of the projected financial statements, and for this purpose I have got a small problem here. It's a very simple problem, very simple information, and we will try to prepare the financial statements with the help of this information for 1 year only, one projected year only, and for the other years we will see in the subsequent slides that how the projected financial statements are prepared and what purpose they serve. So in this case, for example, if you see here, you are given the information in the form of a balance sheet. Whether you call it as a balance sheet or you call it as a document which is presenting us on the one side the sources of the funds brought in the business, right, in one particular year, which we call it as the N year or maybe the current year, and then these are the applications of all these sources. So the firm has raised, right, this firm has raised about 360 million Indian rupees, and they have applied, they have spent this 360 million rupees for some maybe the business purpose, and out of this total amount collected they have only cash, that is of the 20 million rupees, and remaining amount has been spent. 340 million rupees have been spent on converting those resources into the assets, both the long term fixed assets and the current assets, and this way the total information, maybe you call it as a balance sheet or as a statement of information, it is presented to us for the current period, right. So we are written here that to understand the projected financial statements, how the projected financial statements are prepared, let us consider a simple example. So balance sheet of the Pearl Enterprises, right, we assume that this firm's name is the Pearl Enterprises, and at the end of the year N means the current year, is given to us. So you may call it as a balance sheet because it is given in the form of a balance sheet, where on the one side you are given the liabilities, on the other side you are given the assets, and you are given the amount of the respective liabilities and assets. So liabilities include the equity also and the other equity also, and then external liabilities are also given to us in the form of secured loans, unsecured loans, current liabilities and provisions. And all these funds, 360 million Indian rupees, they are generated from the different sources in the year N, in the current year, and they have been applied to raise different kind of the assets, where we have the fixed assets to the tune of 180 million. Investments are not made because we need the funds within the business only, and equal amount of the current assets have been created, and out of these current assets the larger part is on account of receivables and on account of the inventory, and small part is on account of the cash which is available with us. So we have already spent 340 million and we are left with the cash of the 20 million for the day to day purposes. So this is the information given to us for the year N, maybe the current year, and from this information and maybe from the some information which is available to us from the income statement, you call it as income statement for the next year, right, for the projected year, or for the you call it as then immediately the next year after the year N plus 1 year, it is given to us. So we are required to prepare 3 projected statements. So one statement is already available with us, it is already prepared for the N plus 1 year, and that is the income statement, projected income statement. And out of these 2 statements, the income balance sheet for the previous year, maybe for the current year, and the projected income statement for the next year N plus 1 year, we have to prepare 2 projected statements, 2 remaining projected statements. One is the cash flow statement, other is the projected balance sheet. So initially we are given for the current period we are given the information in the form of the balance sheet, and the income statement we are given not for the current year but for the projected period. So, it is already prepared with us, and with the help of this income statement and balance sheet, we have to prepare the two statements, two projected statements. One is the cash flow statement and another is the projected cash flow statement and then the projected balance sheet, right. So, let us learn about how to prepare the projected this cash flow statement. And for preparing the projected cash flow statement, we will be preparing this format. So, we will write here projected cash flow statement, projected cash flow statement, right. So, we are going to prepare the projected cash flow statement, and for this purpose, for preparing this projected cash flow statement, we have to take here, we have to make two columns. One column is of the sources of funds, and then we have to put here the amount, right. This is the sources of funds and this is amount here, and after putting all the sources here, then we will go for the next thing, that is application of the funds. So, in case of the sources of the funds for preparing the cash flow statement, as I told you, we normally prepare the cash flow statement under three activities. One is the operating activities, second one is the financing activities, and then is the investing activities. But just for the sake of understanding, we are not preparing this cash flow statement under the three activities, but only a simple cash flow statement, projected cash flow statement, to have an idea about the closing cash balance available with us at the maybe at the year n+1. So, n+1 means the first projected period. So, it means in this case, for preparing the cash flow statement, where the information is going to come from? The information is going to come from, for example, we are going to use this balance sheet. This is the balance sheet given to us for the current period. We are given already the projected income statement for the n+1 year, which is already available with us, and this includes what? It includes sales, it includes the cost of goods sold, it includes depreciation as an expense. So, profit before interest and tax is worked out, then we have interest, then profit before tax, we have to pay the tax, then after that we calculated the PAT, profit after tax means it is called as the PAT. So, we calculated the PAT, and out of this PAT, part of the amount is proposed to be given back to the promoters, that is a small amount of the 10 million rupees, and larger part, 2/3 we are going to retain, that is the 20 million rupees we are going to retain as a retained earnings, because we need these funds for the business. So, we are given two statements, balance sheet for the current year and projected income statement for the immediate next year n+1 year, and apart from that we are given some additional information, additional details for preparing the two projected financial statements, the remaining projected financial statements, that is the cash flow statement and projected balance sheet. So, this projected financial statement, the additional information if you go through, so it is clearly written here that during the year n+1, means for which the projections are going to be made, the firm plans to raise a secured term loan of the 20 million rupees, right, 20 million rupees, repay a previous term loan to the extent of 5 million rupees. So, this is in terms of the INR, this is in terms of rupees, 5 million rupees, and increase in unsecured loans by rupees 10 million rupees, and current liabilities and provisions are expected to remain unchanged, no change in the short term sources of the funds. Further, the firm plans to acquire fixed assets worth rupees 30 million, right, worth rupees 30 million, and increase its inventories by rupees 10 million, right, and receivables are expected to increase by rupees 15 million, and other assets would remain unchanged excepting of course cash, right. Cash will change because when there is inflow and outflow of the cash, so cash will change. So, excepting of course cash, other current assets and maybe the working capital position will remain unchanged. The firm plans to pay rupees 10 million by way of the equity dividend. So, they want to pay the equity dividend also. So, you call it as any kind of the organization, maybe it is a equity means, does not mean here the company is certainly a public limited company, it may be any form of the organization. And when you talk about the equity, so if it is a publicly held company, it is a publicly listed company, then yes, equity will be the say investment by the shareholders. But if it is a privately held company or a partnership firm or a sole proprietorship, in that case equity means the investment given by the promoters or by the entrepreneurs who own that enterprise or who own that business, right. So some return we propose to give it to back to the entrepreneurs also or to the promoters also. So this information is given to us, detailed information is given to us, and with the help of these three informations, one is the balance sheet for the current year, income statement for the n+1 year, and the additional information for the immediate next year, that is n+1 year. With the help of these three informations, we are going to prepare the projected cash flow statement for the n+1 year, and then we are going to prepare the projected balance sheet for the n+1 year. So this is the format. Normally, as I told you, that we prepare it under three activities. First one is the operating activities, right? Then second one is the financing activities, or you call it as the investing activities, and third one is the investing activities. So these three activities are there. We prepare normally the cash flow statement under these three activities, but here for the sake of understanding and calculating the closing cash balance, we are going to prepare this statement only in a simpler form, and we are on the top we are going to put the sources of the funds, and after that sources of the funds we are going to put the application of the funds. So where the cash will come from and where the cash will go to, and what will be the net difference, that we will calculate. So in this case, sources of the funds, first of all we start preparing this cash flow statement, and this is prepared with the help of, or with the beginning of the cash flow statement is always with the profit. So it is called as the profit before interest, profit before interest and tax. Profit before interest and tax. So it means we have got the this profit before interest and tax. So now we are going to prepare the cash flow statement with the help of these three informations, or three statements available with us. So it means in this case we are given the balance sheet for the current year, and we are given the projected income statement for n+1 year, that is the first next year, maybe the next period, projected period. Already means the projected income statement is given to us, and then we are given the additional information, and with the help of these three informations we will be preparing the projected cash flow statement and the projected balance sheet. So you are given here that during the year n+1 the firm plans to raise a secured term loan of rupees 20 million and repay a previous term loan to the extent of 5 million. So it means net increase in the current year will be how much? 15 million, because we want to raise additional 20 million and we want to repay 5 million. So net increase in the secured term loan will be of the 15 million, and increase unsecured loan by 10 million, right? Current liabilities and provisions are expected to remain unchanged. No change in the short term sources of the funds is going to be there. Further, the firm plans to acquire fixed assets worth rupees 30 million. So misapplication of the cash would be there. So 30 million of the fixed assets would be there, and current assets would also increase in terms of inventory by 10 millions, and receivables are expected to increase by rupees 15 million. Other assets except cash will remain the same, only cash will change. So in the current assets there will be change in the inventory, and there will be a change in the receivables, and of course cash. Other current assets will remain same, and besides this the firm out of its profits want to return something to the entrepreneurs also. So we call it as a equity, maybe investment in any form by the entrepreneur, in any business form by the entrepreneur, we call it as equity. So they want to return something to the entrepreneur also, firm wants to return something to the entrepreneurs also in the form of the equity dividend. So in this case, with the help of this information, three informations given to us, one is the balance sheet for the current year and the projected income statement for the first projected year, and additional information. We want to now prepare the cash flow statement for the n+1 period, means the immediate next year. So cash flow statement normally, as I told you, we prepare under three activities. These three activities are operating activities, right? We call them operating activities, and second activities are investing activities, right? Investing activities, and third one are the financing activities. Right, these are the three activities under which normally these days we prepare the cash flow statement, but this cash flow statement we are not going to prepare under these three activities. We are going to prepare in a very simpler form, and we are on the top going to put the sources of the funds, and on the lower part we are going to put the disposition or application of the funds, because our purpose is simply to find out the closing cash balance, right. Closing cash balance, which will be matching with the cash balance, closing cash balance in the projected balance sheet. And we can easily find out that what is the cash position of the firm, what is the profitability position of the firm. Because if you go to the say profitability position of the firm, you can find out here that the retained earnings are 20, but the total profits are 30 million rupees. We are projecting a total profit after tax of the 30 million rupees. So, is this 30 million rupees is the profit in cash, or it is both cash plus credit? And we, by preparing the cash flow statement, we simply want to know that this out of this total profit of 30 million, profit after tax of 30 million, how much is in the cash and how much is in the credit. So, if the larger part of the profit is in the cash, then firm is doing a good job, but if the larger part of the profit is non-cash, so it means there is no point earning this kind of the profit, and we should sell less but sell more and more on cash. So, to verify this profit of 30 million one, and to check that how much is the closing cash balance available with the firm, and whether that cash balance matches with the projected balance sheet also, we are going to prepare the projected cash flow statement, and then we will prepare the projected balance sheet, right. So, let us now go for preparing this cash flow statement. So, projected cash flow statement we are going to prepare here, projected cash flow statement for n plus 1 year, for n plus 1 year for the Pearl Enterprises, right. For n plus 1 year for the Pearl Enterprises we are going to prepare this. So, we are going to make it a very simple. On the top we are going to put the sources of funds or sources of cash, because it is a cash flow statement. So, sources of cash is how much, means where the cash has come from, and here we are going to write here, this is the amount, right. This we are going to write here the amount. So, we are going to write here is we will take the information from where? We will take the information partly from the profit and loss account and partly from the balance sheet, right. The balance sheet which is given to us, and partly from the additional information which is given to us in the third say set of information. So, we are given three kind of information. We have one balance sheet for the current year, we have the income statement for the projected year n plus 1 year, and then we have the additional information for the n plus 1 year. So, from all these three set of informations, we will take the information and we will prepare the projected cash flow statement. So, first thing we start with the profit. First source of the cash in any firm is the profit. So, we will take here profit before tax, profit before tax with interest added back, with interest added back, with the interest added back. So, how much is that? It is 80 million rupees, right. So, we are writing in rupees million. This statement we are going to prepare is, this is rupees million. So, profit before tax with interest added back, and when you are seeing we say that why we are adding back the interest here, we are taking the profit before tax, because tax we will subtract it as a application of the cash, not here. Source means total profit is coming to us, and in this we are adding back the interest also, because when we have calculated the profit after tax, or maybe the profit before tax, but after interest. So, it means we have subtracted the interest here, but interest is not basically the operating expense, interest is basically the financial expense. So, number one, if we are preparing the financials, this cash flow statement under operating, investing and financing activities, so that is one reason that to calculate the cash flow from operations, we would have added back the interest. But here that is not the purpose, because we are not preparing this statement under the three activities. We are only preparing a plain statement under sources and application of the cash. So, in this case also we are saying that when you talk about the interest, we will not subtract the interest here in the sources. We will subtract the interest in the lower part while showing the disposition or applications of the cash. So, we will start with this cash flow statement, we will start with profit before tax with interest added back, and this is 80. So, where this we have taken the 80 from, this 80 has come from this information, and this is the profit before interest and tax is the 80, million rupees. So, we have taken this from the income statement. So, this is the our requirement and we are doing here. Next thing is we are going to add something next thing, and that's next item we are going to add is a depreciation. So, next is the depreciation. So, what is depreciation? Why we are adding back depreciation? In the previous class also I told you depreciation though is an expense, it is a fixed expense, but it is basically non-cash, because we only make a book entry in the profit and loss account, but we do not pay this amount to anybody as an outside stakeholder, we do not pay it to anybody. So, it is only a book entry. The cash does not move out because of the depreciation. Maybe it is a depreciation or a preliminary expenses or any other kind of the expense which is capitalized and which has been paid earlier, and this time only we are making a book entry or we are going to recover it through balance sheet by capitalizing it in the balance sheet. So, depreciation being a non-cash expense, the amount which is shown or which is debited in the income statement, we are adding back here and in the cash flow statement, because it is only a book entry in the income statement also, and no cash has moved out on account of depreciation. So, depreciation is basically a source of the cash, and it may be expense in the income statement, but in the cash flow statement it is a source of the cash, and the amount given here is the 20 million rupees, right. Next thing is the cash is from increase in the secured loans. So, it was given to you increase in secured loans. So, this information is given to you. This information is given to you in the additional information. So, if you go to the additional information here, you will find out that what is the information. He is writing here that there is going to be the firm plans to raise a secured term loan of 20 million rupees and repay a previous loan of the 5 million rupees. So, in this case we are going to have the additional funds from the secured loan, and this amount is going to be how much? We are going to raise 20 million, but we are going to pay 5 million. So, net increase in the unsecured loan is going to be how much? This is going to be for the 15 million rupees, and there is going to be similarly other increase in the loans, increase in the unsecured loans, increase in the unsecured loans. So, we are going to take here unsecured loans. So, increase in the unsecured loans, unsecured loans. So, it was given to you in that information as well. If you see here, unsecured loans are also going to, so there is going to increase of in the unsecured loans, and that amount was how much? That amount is 10 million rupees. So, this is the total sources of the cash. We are not getting any cash from any other source. So, you can call it as the total, total amount of cash from all sources, from all sources. You call it as A, right? We call it as A. So, total amount of the cash from all sources, if you total it up, it is going to be how much? It is going to be 120 million rupees, 120 million rupees. So, this amount of the cash is going to be available with us. So, we are going to have this cash. So, this is going to be 125 million. So, this is going to be 125 millions of the cash is going to be available with us. So, first source of the cash was profit before tax with the interest added back. This is 80 million, right. Depreciation is a non-cash expense. So, we debited in the income statement, but the cash is not going out anywhere. So, being a non-cash expense, we are adding back here to show the cash. Increase in the secured loans, that is 15, and unsecured loans is 10. So, it means total is the total amount or total amount of cash from all sources, total amount of cash from all sources, this is 125 million. So, this is coming to us. Now, next part will be talking about the applications of the cash, or you call it as a disposition of the cash. Applications of the cash. So, where the cash is now going to, this much of the cash is available with us, and now from this we are going to use this cash. So, where this cash is going to be used? First cash means application of the cash is the capital expenditure, right. This is the capital expenditure, and for this purpose capital expenditure, where we are getting the capital expenditure from? It is clearly written to us that current liabilities and provisions are expected to remain unchanged. So, it means only secured and unsecured loans are going to change. Further, the firm plans to acquire fixed assets worth rupees 30 million and increase its inventory by 10 million and receivables by 15 million. So, it means there is going to be a capital expenditure of 30 million, right. So, capital expenditure is going to be how much? Fixed assets are going to increase by 30 million. So, we are going to increase it by 30 million, and then we have to go for the increase in the working capital. Increase in working capital, increase in working capital. So, we have to take here the increase in working capital. When we talk about the increase in the working capital, so it means we have to take here increase in working capital. So, total increase in the working capital we are writing here is the 25 million. How there is increase in the 25 million in the working capital? Look at this, right. It is given to you that your inventory is going to increase by 10 million, right. Increase in inventories by 10 million and receivables are expected to increase by 15 million. Both are the components of the working capital. Working capital is basically the say total of current assets minus current liabilities, which is called as the NWC or the net working capital. We have the two kind of the working capitals. One is the gross working capital and one is the net working capital. Gross working capital is the total of current assets, TCAs, right, and net working capital is the current assets minus current liabilities, right, current assets minus current liabilities. So, net working capital is the total current assets minus current liabilities and gross working capital is the total current assets. So, we are writing here increase in working capital because your two current assets, one is the inventory and second one is the say receivables, or you call it as the sundry debtors. Both are the components of the working capital gross current assets. One is increasing by 10 million and another is going to increase by 20 million. So, read it here that inventory is going to increase by 10 million and the receivables are going to increase by 15 million. So, this is 10 plus 15. So, this becomes the working capital. 15 million is total by the receivables and the inventory is 10. So, 10 plus 15 is 25 increase in the working capital, and then we have the interest we are going to pay now, the interest which we have added back there. Now, we are going to pay the interest here, interest payment you can call it as interest payment. So, how much interest is due to be paid? We will have to go back to that income statement, and in this income statement we will have to find out what is the interest component. This is 20, right. Earlier we added back in the we called it as a source of fund, but now we are going to pay it. So, this is the payment of the loan, and when we are going to pay this interest. So, this interest is 20 and interest on the loan is going 20 to be paid. So, this is also causing the application of the cash. And what else is there now? We are left with something else. Here is this is the after this interest we have the taxation. So, tax to be corporate tax you call it as. So, this is the corporate tax we have to pay now, and how much is the corporate tax you can find out. It is given to you in the statement. So, corporate tax here it is the 30 million rupees corporate tax we are going to pay, and we have to pay the dividend also for the 10 million rupees. So, it means in this total process we are going to make two more payments also. So, corporate tax is going to be how much? 30 million, and we are going to pay the dividend. So, this is the payment of dividend or any return to be paid to the entrepreneurs or to the promoters, and this is going to be 10. So, this is the total applications of the cash. We have not prepared it under these three activities, but we have prepared it in simple statement just to know about it. What are the sources of the cash in the year n plus 1, and what are the applications of the cash in the same year, and finally what is going to be the net balance of the cash. So, now to find out this we have to find out the total of this A was 25 and total of B, right. This is we call it as the B. So, you call it as the total applications of cash. Total applications of cash. So, it means how much is going to be the total? This total is going to be 115 million. 115 million is going to be the total application of the cash, which we call it as the B. So, A and B, and now for this we have to go for the next continuing with this process we will have to find out now to the closing closing cash balance. So, it means in this case opening cash balance, we will continue the statement here, opening cash balance. what was the opening cash balance? If you read the balance sheet, if you see the balance sheet in the for the current year N, you are given there, that is the opening this balance sheet of the opening balance of the cash. And if you see the opening balance of the cash in the projected balance sheet, so here it is a cash given to you and this is 20, right? This is given to us 20. So we will take this 20. First of all, opening balance of the cash is how much with us? 20 million, right? And in this we will have to find out from the how much is the difference, net surplus oblique deficit, net surplus oblique deficit from A and B, right? A and B. So you call it as A and B, A minus B. So this is going to be how much? Net surplus oblique deficit A minus B is going to be how much? This is going to be 10 million. So finally you can say the closing cash balance in hand, closing cash balance in hand oblique bank. So this is going to be how much? This is going to be finally 30 million. This closing cash balance is going to be 30 million with us, and this closing cash balance is going to be the part of projected balance sheet also. So now let us go back to this. If you see here that what is the closing cash balance? 30 million closing cash balance is with us. And if you see here, how much is the profit here? The profit we also got was 30 million. So it means by seeing this, that profit after tax projected was 30 million, projected after tax projected was 30 million, and we have got the cash also, closing cash balance also of the 30 million. It means the financial position, the cash position of the firm is good and there is nothing to worry about, and we have got all kind of the maybe sales which are mostly on cash. So if you see here the opening balance of the cash, though there was a sufficient opening balance of the cash also, 20 million of the opening balance of the cash was also there in the balance sheet of the Pearl Enterprises for the year N. In the current year, that is 20 million was the opening cash balance. And from the year N plus 1, when we prepare the income statement which has given to us the total profit of 30 million, profit after tax of 30 million. But here one important point, the cause of concern is that if you see here in the cash flow statement, right, if you see in the cash flow statement here, the difference between the A and B for the year N plus 1 is only 10 millions, right? Surplus we have got is 10 million. So had this 20 million in the previous year or in the current period been not there, then the closing cash balance of 30 million would not have been there. So it is largely because of the very good cash balance which was there in the current years of the balance sheet. As far as the N plus 1 years of the cash position is concerned, against the total profit of 30 million, total profit is how much? Rupees 30 million, right? And against that, how much is the cash? If you see here, this is the cash of the 10 million. It means only 1/3 of the sales are producing the cash profit and 2/3 of sales are producing the credit profit, which is also not a good thing. So we should not feel happy that closing cash balance is equal to the profit. We have to see in this case also that how much is the opening cash balance, means from the previous balance sheet, how much cash is moving forward to the next year. And from the current year, means next year means the current year, how much is now the net difference maybe between the total applications and the, see when you talk about here is the total sources of the cash 125, total applications are 115. So the net difference here is going to be how much? Difference is going to be only 10. So though we have the closing cash balance of 30 million here, but this 30 million is largely because of 20 million have come to us from the previous year, and in the current year larger part of the sales have been on credit because the profit is also on the credit, and the cash component is very less because the net difference between the total sources and applications of the cash for the year N plus 1 is only 10. So against the profit of 30 million, cash is only 10. So does not mean that we have a closing cash balance of 30 million, it means this has come from the profit of the N plus 1 year. No, This is largely because we have a sufficient cash from the previous year. When that cash was moved from the previous year to the current year or maybe to the projected year, and net surplus of the projected year was added. So, somehow it became equal to the profit of the projected year, but it is not the case. So, we have to be very careful, and if you present this kind of the cash flow statement to the investors and tell them that we are going to sell and we are going to get a profit of some certain amount, and the profit of this is going to be 30. But when they ask for the cash flow statement and cash is only 10 coming out of the n plus 1 year here, and this going to be n plus 1, the cash is going to be 10. So, they may ask many questions. So, always restrict your sales and try to sell maximum on cash. Credit you have to give, but keep the credit sales as low as possible. Sell maximum amount of the sales on cash. Maybe the amount of sales may be little lesser, but you will be saved from the bad debts, the severe bad debts problem, because larger the amount of credit sales you are going to make, larger the amount is going to be caught in the bad debts, and that is going to maybe sometime going to lead the firm towards the sickness. So, we have to be very careful, and we have to understand that when you prepare the say income statement, and whatever the profit is depicted by that income statement, projected income statement, try to find out how much cash is going to be there, means out of that profit. And in the present case we have found out is that against the total projected profit of 30 million, cash is going to be only 10 million. Though the total cash position is comfortable, but not because of the profit from the current year or maybe projected year, but it is because of the sufficient amount of the cash of 20 million flowing from the previous year. So, this kind of situation should be avoided, and we should have sufficient amount of the cash profits rather than the total profits, and in that total profit having the chunk of the credit profits higher than the cash profits. We have to avoid that position. So, at the moment we will stop here, and in the next class we will talk about the preparation of the projected balance sheet, and from this given information we will prepare the projected balance sheet, and then we will try to understand that how this projected financial statements are prepared by seeing some already prepared projected statements and trying to understand the concept of projected or dummy or maybe the pro forma financial statements, which serve or which play a very critical role by raising the funds from the investors and going to maybe to the institutional finance, because they would like to see the projected financial statements before taking any investment decision about this particular project or in this particular project. So, the projected balance sheet part we will discuss in the next class. Till then, thank you very much, and we will discuss the projected balance sheet in the next class. Thank you.